Have you ever wondered how to access your 401k funds in case of an emergency? It's a question many of us have asked, and the answer begins with understanding your employer's policy on 401k loans. Consider this. Not every employer offers the same provisions. Some may allow you to borrow from your 401k account while others may not. It's crucial to know where your company stands on this matter. Think about it like this. Your 401k is not just a savings account, it's a significant part of your financial future, and making a decision to borrow from it shouldn't be taken lightly. But how do you start? Simple. You begin by consulting your employer, or more specifically, your human resources department. They are equipped with the information you need to understand the specifics about your company's 401k loan policy. You see, every company has different rules and regulations. These can range from how much you can borrow, to the repayment terms, to the interest rates, and even to potential penalties for not adhering to the terms. Understanding these details is absolutely critical before you decide to take the plunge. So, when you're considering a 401k loan, remember this. Your first step isn't filling out a form or calculating how much you can borrow. Your first step is to verify your employer's stance on 401k loans. Only then can you make an informed decision about whether this is the right path for you. Remember, your first step is to verify your employer's stance on 401k loans. Once you've confirmed your employer's policy, the next step is to understand the loan terms. Now let's talk about borrowing limits. These are the maximum amounts you can borrow from your 401k account. Typically, you can take up to 50% of your vested account balance, but not more than $50,000. Remember, the money you borrow is not growing in your retirement account, so consider your borrowing limit carefully. Next, we have repayment schedules. This is the plan you set up to pay back the loan. Usually you must repay the loan within 5 years, and the repayments are often deducted directly from your paycheck. It's important to understand your repayment schedule and make sure it fits within your budget. Interest rates are another crucial element. While you're paying the interest to yourself, not to a bank or credit card company, the rate is typically 1 or 2 points above the prime rate. It's important to note that if you leave or lose your job, the loan may become due much sooner, and failing to repay can have significant tax implications. A 401k loan is not a decision to be taken lightly. It's a complex financial tool with potential risks and rewards. Understanding the borrowing limits, repayment schedules, and interest rates is crucial before you proceed. Knowing the terms of your 401k loan is key to avoid potential pitfalls. With the terms understood, you're ready to complete the necessary paperwork. This stage is crucial and demands your attention. It's about more than just filling out forms. It's about ensuring that every bit of required information is accurately provided. You see, the paperwork is a detailed record of your commitment to repay the loan. It's a formal agreement between you and your 401k plan provider. But don't let that intimidate you. It's a straightforward process. You'll need to provide your personal details, the amount you wish to borrow, and your agreement to adhere to the repayment schedule. Remember, it's not just about getting the money, it's about understanding your future payment obligations. So make sure you read everything carefully, ask questions if you need to, and once you're confident that you've filled it out correctly, go ahead and submit it. Once your paperwork is submitted, you're one step closer to receiving your loan. After your application is approved, it's time to receive your loan disbursement. This is the moment you've been waiting for, when the funds from your 401k loan make their way into your bank account. Typically, you'll find the loan amount directly transferred, appearing as a sudden boost to your balance. It's a significant financial event, and it's essential to be prepared for this influx of money. Think of these funds as a tool, not a windfall. They're there to serve a specific purpose that you've identified, not to be used on a shopping spree. It's not uncommon to feel a sense of relief washing over you as you see your bank account swelled, but remember, this is a loan, not free money. Handling this disbursement responsibly will set you on the right path towards repayment and ultimately, financial stability. Receiving your loan disbursement is a crucial step, but remember, repayment is just around the corner. Now that you have your loan, it's vital to commit to regular repayments. This is not just about meeting your legal obligations, it's about safeguarding your financial future. The repayment schedule for a 401k loan might be monthly or quarterly, depending on the terms agreed upon. It's crucial to stick to this schedule religiously. Why, you might ask? Well, there are several reasons. Firstly, if you fail to make repayments on time, you could face tax penalties. The IRS treats missed repayments as an early withdrawal from your 401(k), which is taxable, and may also incur a 10% early withdrawal penalty if you're under the age of 59 and a half. Secondly, missed payments can transform your loan into a distribution. This means the balance of your loan becomes taxable income, and you might be hit with that 10% penalty we just mentioned. But the implications of missed repayments go beyond tax penalties. Every dollar you borrow is a dollar that's not invested for your retirement. So if you're not repaying your loan as scheduled, you're potentially damaging your retirement savings by not allowing them to grow as they should. You might think of it this way. Each repayment is not just paying back a debt, it's an investment in your future. It's a way of ensuring that your retirement savings continue to grow and serve you when you need them most. So, how can you ensure you're committed to regular repayments? Consider setting up automatic payments from your paycheck or bank account. This way you won't have to worry about forgetting a payment. Also, keep a close eye on your budget. Make sure you're not spending unnecessarily and that you have enough to meet your repayment obligations. In conclusion, adhering to your repayment schedule is not just about avoiding penalties. It's about securing your financial future. It's about ensuring that when the time comes for you to retire, you have a substantial nest egg waiting for you. Staying committed to your repayment schedule is integral to successfully managing a 401(k) loan. While you're repaying your loan, don't forget to maintain regular contributions to your retirement plan. This is a mantra we should all keep in mind. You see, when you borrow from your 401(k), it can be tempting to pause your regular contributions. After all, you're already paying back into the plan, right? But here's the catch. Halting your contributions during the loan period could have a significant impact on your long-term retirement savings. Why? It's all about the magic of compound interest. When you contribute to your 401(k), your money doesn't just sit there. It grows, it multiplies, it works for you. Every dollar you put into your 401(k) now could be worth much more by the time you retire, thanks to the power of compound interest. But if you stop contributing, you're leaving potential growth on the table. You're missing out on the chance to multiply your money. Furthermore, many employers match a portion of your 401(k) contributions. If you stop contributing, you're essentially turning down free money. Money that could be growing and compounding in your retirement account. So while it might seem like a minor detail amidst the larger task of repaying your loan, maintaining regular contributions to your retirement plan is crucial. It's about securing your financial future and ensuring your nest egg continues to flourish. Continuing your regular contributions ensures your retirement savings keep growing, even while you're repaying your loan. A 401(k) loan can be a useful tool, but it's not your only option. It's essential to remember that financial planning is like a jigsaw puzzle, where each piece represents a different financial tool. And just like in a jigsaw puzzle, each piece has its place. Let's consider some of these alternative pieces. There's the emergency fund, a safety net that can provide financial security when unexpected expenses hit. It's like an umbrella, ready to protect you when the financial rain pours down. On the other hand, we have taxable investment accounts. These are like seeds that, when planted and nurtured, can grow into a robust financial tree. They offer the potential for growth and income over the long term, but they come with their own set of risks and tax implications. Then there are low-interest loans. These could be personal loans, home equity loans, or credit card balance transfers. Think of them as financial bridges, helping you cross over a temporary gap in funds. But remember, bridges need to be crossed carefully. You don't want to slip and fall into a cycle of debt. The key is to weigh all these options and their implications before making a decision. It's like balancing on a tightrope. You need to consider all factors to maintain your financial balance and avoid a fall. Remember, a 401(k) loan is just one of many financial tools available. Always consider your options before making a decision.